Hello everybody, welcome back to another video, and in this video we are going to be discussing about what is the difference between the owner's capital and the capital employed. And yes, you have seen a number of times that this question comes in the exam where they ask you to calculate what owner's capital is and they ask you to calculate the capital employed. But now let's see how is this actually calculated and what does this signifies. So students, owner's capital is basically representing the investment that the owner himself has made from his own personal funds, right? That is how much the capital the owner has introduced himself. Now you know that the owner invests certain amount of money in the business, and that the investment that the owner makes is the capital of the business, or you can say that is the owner's capital of the business, because that is the money that the owner has invested in the business in order to run the affairs of the business. And from that money the owner buys different assets and run the operations of the business and earns profit out of it. Okay, so that is what owner's capital actually is. That is the amount of money that the owner himself invests from his personal funds. Now it is calculated by the formula total assets minus total liabilities. So for example, let's assume that the owner invests 100,000 into the business, and from that 100,000 he buys an asset. So we can say he buys asset 1. Okay, so asset 1 is 100,000. Now the owner also borrows a loan, right, for maybe 50,000, and from that 50,000 he buys another asset, that is asset number 2 for 50,000. Okay, so now we have two things over here. Firstly, the owner has invested himself 100,000 into the business and he has bought an asset for 100,000, and he's also taken a bank loan for 50,000, and from that 50,000 he has bought another assets. So the total assets are basically how much? Total assets are 150,000. So 150,000 are the total assets that the owner has bought. And so now the thing is that if you want to calculate the owner's capital, what we will do is that we're going to place 150,000 under the column of total assets. Okay, and we are going to deduct the total liabilities, that are how much? That are 50,000. Now the reason for doing this is very simple, I'll tell you, and the answer would be 100,000, and 100,000 would actually represent the amount of owner's capital. Now why have we deducted 50,000 from 150,000? The simple reason is that 150,000 represented the total assets. Okay, and these total assets were financed from two sources, right? They were financed from the money that the owner has invested, plus they were financed by an external source, that is a bank loan. Okay, so now out of that 150,000 we want to see that how much assets are actually financed by the owner himself. So we come to conclude that 150,000 out of 150,000, only 100,000 of the assets are those assets that the owner has financed himself from his own money, which is actually representing what? It is representing the amount of investment that the owner had initially made, and from that 100,000 he had bought the assets. So the amount of assets that the owner has financed from his own money is actually representing the amount of investment that the owner had made into the business, and from that money he had bought those assets. So that is why we have to deduct the total liabilities, because the total liabilities are the liabilities or the money that the business has obtained from other sources, and from that money the business has bought assets, and that money has been invested back into the business. And since that money is not the money of the owner, although it is representing an investment because that money has been invested into the business, but since that money is not the owner's money himself, that is why we deduct it from the total assets, so that the figure that we arrive at is actually the money that the owner has invested himself from his own personal funds, right? Okay, so this was about owner's capital. Now let's move on to capital employed. So capital employed, students, is the total capital that is invested into the business, and this total capital that is invested into the business by the owner himself. Okay, so first things first, it's a total capital invested into the business by the owner himself, and that is the owner's capital that we just calculated above, plus all the capital that has been invested by obtaining finance from external sources such as a bank loan. So for example, some of the money the owner has invested himself, that is the owner's capital, plus the owner has obtained a bank loan or maybe issued debentures or whatever, and he has invested that money which he had financed by external sources, he had invested that money back into the business, and as a result of that, the total amount obtained, that is the owner's capital, plus the money that the owner has obtained from external sources, the total amount together form the capital that has been employed into the business. That capital that has been employed, which means that the total capital that has been invested into the business by the owner himself from his personal funds and by any other external sources through a bank loan. There's another formula for calculating capital employed, and that is you deduct the current liabilities from total assets. The simple reason is that total assets are representing the total amount of investment that has been made into the business. So whether by the owner himself or through the money that has been obtained from external sources. So you deduct the current liabilities from it. The reason is simple, because the business is going to be repaying the current liabilities relatively quickly from the cash and all the other current assets, because these current liabilities will have to be paid by the business, and that is the reason, because the current liabilities will be repaid by the business relatively quickly from the available cash and all the other current assets of the business. That is why we deduct the current liabilities from the total assets in order to arrive at the capital that has been employed by the business, or the capital or the total capital that has been invested by the business. So this was the basic difference between owner's capital and capital employed. So for example, if I say that at 31st of December 2020 my total assets are equal to, for example, 500,000, right? So that actually means that if I say, so that actually means that this is also representing the total capital that I have employed. It is also representing the total capital that I have employed. Okay, however, one thing, remember that if I have current liabilities which I have to pay in the next coming 1 year, and I know that as of 31st December 2020 maybe 50,000 of the current liabilities will have to be repaid in the next 1 year. So that means that there will be an outflow of cash in the coming 1 year. So I'm going to deduct that current liability from 500,000, because although 500,000 is the capital that I have employed in the business, however, I also know that 50,000 will represent an outflow of cash in the next 1 year. So the total capital that I have employed in the business is going to fall, and hence I can, and hence I'm going to say that my actual capital that I have employed, or the correct capital that I have employed, is not 500,000 but it is 450,000. I hope you enjoyed the video, students. Keep watching and see you next time.